those of you that don't know, I was invited here by Rob Chastain, who's a colleague of mine. We've been trading together for some time, and he invited me to come on and sort of flesh out a little bit more of the seminar after his piece. So I want to talk about market internals. A lot of you who are familiar with my work know that this is kind of the bread and butter, really, I would say, of my work. I overheard parts of the seminar with Rob, and some people were asking, which do you like best, whatever, and Rob says, yeah, I like broken wing butterfly, I like collar. Each trader kind of has their bread and butter of what their kind of go-to strategy. And the first thing I want to say is that it's very, very important in trading that you have to choose a go-to strategy, quote unquote, that you're most comfortable with. If it's something that doesn't fit your personality, then it's probably not going to work regardless of how solid it is. And I don't want to discourage anybody, but that is really the case. I've time tested and through experience I've traded a lot of different strategies, short-term, long-term, medium-term, some fast, some slow, some complex, some very simple. And I come to the conclusion after a long time is you really get good at just one or two things, and you tend to get very good at the stuff that you're comfortable with. You're either comfortable with it from a risk-reward standpoint, or it's things that you're comfortable with just because the style of trading per se seems to fit your personality. So what I'm going to present here is going to be more of a short-term way of reading the markets, but I don't want anybody listening to the presentation to be turned off immediately thinking that, well, he's just a day trader, or I'm not a day trader, so this doesn't pertain to me, because I firmly believe that what I am about to discuss pertains to everybody. It fits hand in hand, especially with what Robert was presenting on the SPX. What I'm going to talk about is using these market internals to gauge intraday direction. And believe me, regardless of how long your time frame is, if I could help you just a little bit to get a better grip on what's happening in the market in the next 15 minutes, I think you would have to agree that it's going to be of immense value to you when, for instance, you're doing the butterfly strategy that you learned from Rob, and you have a market moving into a short vertical, or some position in your matrix where you're exposed, and you're staring down the barrel of 50 to 100 contracts, maybe more, hundreds of contracts, whatever, or maybe wherever your risk tolerances could be 5 to 10 contracts for you, it doesn't matter, but regardless, you're staring down the barrel of that gun. It would really behoove you to know whether or not the market's going to turn intraday, whether the move is going to be sustained, whether the move is going to keep going right into your face, and you need to adjust that fly and get out of there, or do you know the move is just it's probably going to die out, it's probably not going further, I'm okay, let's just let this ride, let's collect some theta, whatnot, right? Okay, so that's pretty much what we're going to go into. Before we do, however, I figured that to kick this off, I would start off on the chart in front of you, only because it ties in perfectly with what Robert was saying, that if you'll recall, he closed his portion of the seminar talking about huge open interest in S&P options on the put side, and I noticed that he was talking about 550, 570, 600 level. So I thought it would be very interesting for us to start with a really simple trend line chart, which is monthly. Each bar is a month, and obviously these are real tiny, but look how far back we're going here, okay? This is 1932 in the SPX, and look at how perfectly trend line support has worked every time, and this is the simplest tool in your tool bag, but it's one of the most effective. It's like a hammer to a carpenter. I mean, you got to have it, So look here, it's 1942, and then we had a nice rally. We touched here. This is 1949. Now, makes perfect sense. We had some boom time here, right? This is 1950s. Everything's just going great. Everybody's got 2 Chevrolets in the garage. Boom, 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 blah, 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 right? After World War II. And when we come down and sell off, which is in the recession time period, early 1970s, right? Look where the low is. July of 1974, right? I was just a little kid back then, but I'm sure some of you were already out there working, doing businesses, whatever. You probably remember this was probably a crappy time for you, right? Things were not going so hot. And notice where the market caught itself. Again, right on the trend line. And then we stayed above the trend line. 1982, right? Rock and roll, 80s, right? All that stuff. Boom, boom, boom. Internet revolution, and look where we are now. And all the open interest on those puts is sold where? 550 to 600. Well, I think it bears note that look where right here it's going to show you where the y-axis is up here. Look what it says on y-axis when I put the pointer right there. All right? It's right around 550. Right there. That's 592, 583. You're going to be looking on the y-axis, which is appearing right here. It's blank now when I move the mouse, but I put it here. So right where we are now is exactly 683. And anyway, so generally, as Rob has taught you, I'm sure, in this seminar and in previous ones, you tend to have markets move to where there is the greatest amount of open interest, right? That's how you kind of look at options when you're coming into expiry. You have huge areas of open interest, and the market tends to move right there, thereby, making the greatest number of people wrong, or however you want to look at it. So I just thought we'd kick it off with this trend line. I think it's pretty interesting. The hard part to muster about this is, of course, that you're looking at another 18% drop before there's any sort of technical support level in the markets between now and there, right? Look at, from 680 to that roughly 550. It's a decent sized percentage drop. So we may not catch ourselves, and also technically note that we have violated the low side here of the prior move down, which was 2002 and 2000. It was 02 and 03 basically. There was a nice low here, which I would have thought would have supported the market, and it did not at all. So that tells us that from here to here, it's probably just a straight down move to the trend line, because one of the things I always like to look at is to simply, quote unquote, look to the left of the chart. And I'll see if I can't blow this up just a little bit for you guys to see. I got to get over here. Put this here. There we go. So now that this area has been violated, the point I wanted to bring up is, look, that over here, there is still the straight up move where the markets did not pause at all. And where you have areas of straight up, doesn't matter what the time frame is. It could be intraday, hourly, 15-minute, all the way out to these monthlies. Remember this, that areas of straight line advance will not support when the market comes back down through those areas. And areas of straight down move, like really bearish moves, right, will not resist when the market moves back up through them. It works both ways. So all this is really tying in really well. When you see the open interest that Rob's talking about, there's the 550. You can see it much clearer. You see the trend line support. This is where I feel the market is probably going, and it's probably going to be ugly because obviously it's a little bit further down to go. Before we get to the other part, does anybody want to offer any questions or comments on this chart, talking about this long-term S&P trend and this trend line support, etc.?
Yeah, I have a question. Is that a regular straight line graph, or is that some kind of logarithmic graph?
Did you hear that, Peter?
No, just straight. He's asking if there's any special log scale on the graph.
Yes, that's what he's asking.
Right. No, just regular. Just regular scale.
Looks like we're good for now, Peter.